Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 20 minutes here on Options Guide TV. Today, we are taping this show. I am traveling. The date is Friday, October 10th. And we're looking at quotes from not Friday, October 10th, but I want to talk about a trade and a strategy that I'd like to do around earnings. We're going to be kicking off earnings season. A lot of times, well, the financial companies usually are the start to the earnings season. And we have Goldman Sachs announcing earnings on Tuesday, the 14th before the open. So I'm going to look at, let's say we had a position on in Goldman Sachs. And if I were to take a position, I'd want to get bullish on the underlying. And I'm going to look at a bull call spread. And then I'm going to talk about what if things don't go right with that bull call spread. So I've already executed using the Tradier Pro paper trading software. And I've already executed that bull call spread. So let's run to the Tradier Pro software right now. And I'll show you that. Okay, so we have Goldman Sachs trading right here at 797.25. Now, the markets are open and they are rocking and rolling right now. Now, more importantly, I just wanted to look at the strikes that I am using to set up the bull call spread. Now, usually if I'm going to do this, and I am pretty bullish on the underlying, I want to go a little bit in the money on the call option that we bought. So inside the Tradier Pro option grid, on this side of the chain, we actually have the calls, and on this side of the chain, we have the puts. And I always like to focus a little bit on, when you go in the money, what is the extrinsic value? How much time premium are you paying to get into this trade? Now, we're looking at the October 24th expiration. Right over here, it's highlighting it, and it's highlighting it there. So we're going beyond the earnings report. And we're also highlighting in this scenario that the earnings report is going to occur in this week, in this expiration, which is the October 17th week. Now, if the last time that Goldman announced earnings, and they'd beaten the last 4 quarters, they had a strong report, but the stock sold off a little bit. The stock then bounced back, and now it's doing well again. So in case of that scenario, I always like to try to set up the trade so that I can do at least one adjustment on the trade. Part of the reason why we're going out to the 18th, we're giving this thing a little bit of a few days to run, but we're really doing it mainly around earnings. And we're going to go fairly wide, but the implied volatility allows us to go fairly wide on this trade. So buying the 790, we're paying $22 in intrinsic value. And then we're going to go out and sell the 825 option contract, the 825 strike option contract. And obviously, this is all extrinsic value because it's out of the money. So the scary portion of this trade is that we are buying $22 in extrinsic value, and we're selling $13 of extrinsic value, otherwise known as time value. So we have quite a bit of time exposure, even though we're doing a long call spread. So that's fine if the market opens up and it blows through your strike and you're profitable on your trade. And it's not fine if it doesn't make it all the way there and you have time decay that's eating away at your 790 strike. So I've already executed this trade inside the paper trading portfolio. So here's the portfolio right now. And we see you have the 790 call option and you have the 825 call option that's in it. You are long this one, you are short that one on the trade. Now, if Goldman announces earnings and something happens like it did last time, and that's the main reason why I'm bringing this up, and the stock just kind of goes nowhere, it kind of muddles around a little bit, what I like to do is adjust the short call. So in other words, I'll take the 825 strike call and I will roll it down. And I don't even mind selling an at-the-money option contract if I will, or give myself a little bit of room to run to the upside. But if you do that trade, you're looking to bring in an additional premium above it and beyond whatever the initial premium was that was sold. So if I go back to the options grid and I look at this, we're bringing in some real cash here, right? We're paying, we'll call it $29.90. Well, that's on the asking price. Over here, we're receiving $13.30. If we hit the bid price, we would work somewhere in the middle. The middle is right around $15.85 if we just did the midpoint on this underlying trade. So here's what a roll may be. You do this trade, you put it on, and then the order executes. It's inside your portfolio, and now you want to roll this trade. So if I click on the actions button and I click roll, it's going to put this down below, and it will actually adjust the strikes. Now, I don't want to adjust the strikes in our scenario because I want to stay within that same period. I don't want to go out longer because this is our short option contract, and that the brokerage firm wouldn't like that if you have a longer dated option than your long option contract that's in your account. So we're going to stay in the same expiration. So your eyes would focus down here. We're 10/24 is the expiration that we have. We would put this to 10/24, but we would go down in strike. In other words, it didn't move as much as we expected it to, and we'd roll down to the 8/15 strike, maybe the 8/20. It would depend on where the underlying stock is at. And right now, if we did that trade, we'd be bringing in a net credit of $3.67. So that would definitely be a different number, but that's how I would execute my roll on the trade. Go back to the actual trading grid. We have our portfolio on where we're at and let's go and look at the portfolio. We're at the 790 sold to 825. So 790 sold to 825. We're going to be buying to close the 825 and selling the 815, saying that Goldman opened up. It didn't open up as much as expected. Let's try to capture some additional premium. One of the beautiful things about that is that time and implied volatility crunch is going to happen to the option contract that we sold. And there's going to be a potential to make a gain on that contract if, obviously, the market behaves and doesn't, first of all, blow away our strike or go way down after the earnings report. But this is one way that allows you to get into the trade at a decent price around earnings, but then have a plan if things don't quite go well. So if I'm going to execute this trade, I put this in. Let's see, I'm going to have to give it, because we're inside the paper trading app, we're going to look at a net credit of $3 and see if it will fill, and I'll send that to the floor. You'll see it pop up over here. And now we're going to be working that order inside this account in order to, this is the open trade for the net credit, and the net credit is $3 or $300 on this position. Oh, it's 300. It should be $3. 300 would be the net credit. So let's adjust this right here, real quick, like. And I don't know where I put 300 in. We're going to go 3 and hit send. And so then if we do get that adjustment on this trade, we'll be filling this for a net credit of $3, and we would be bringing in an additional $3 on the trade. I would probably get a little bit better than that, but this is inside the paper trading app. So that's the adjustment. We go in, set up a trade, like to set it up by a little bit in the money, sell a little bit out of the money on a position that I like on an underlying stock, but a stock like Goldman is fairly expensive. So you're going to have to pay a lot of premium, and you're going to receive a lot of premium on the option contract that you sold. That premium that you received on the one that you sold, you're able to adjust if you would like. Implied volatility will come in. It will hurt the one that you own, but it will also help the one that you sold. So let's take advantage of it. If it doesn't quite reach our strike, we close that out and roll down in the same expiration to that same or to a different strike price, and bring in additional premium to help lower our initial cost basis on the trade. I'm bullish on Goldman. We did a time spread going into it inside Options Guide TV. This is an alternative trade. If you would like to look at it going into the earnings report on Tuesday, I'm not here to be able to talk with live markets, so I thought I would talk about an adjustment, a potential adjustment in a trade in a bull call spread around Goldman, around earnings. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.